Jubilant, Pharmanova, CRISIL, and Titan are other names where even close to 5% stake. So that's been the large holdings of RJ. I've just looked at holdings which are more than 5%. Of course, there is a long list of other names as well, even small stake. But if you look at, while he's no more now, but if you look at his legacy, clearly it shows up that he had such a good Midas touch when it comes to the equity investments. In the last 1 year, a lot of his holdings have done really well, up between 25% to 140%. If you look at the biggest gainer in the last 1 year from his holding, the top gainer is NCC. That's up 140%. Something like a Viatech, Wabag is up close to 108%. Aptech has rallied nearly 90% from his portfolio as well. So that's been the key holdings. But if you look at even the Tata Group stocks, where he had such a large positions, and here he was so bullish on that group itself. Tata Communication within the Tata Group stock has rallied close to 55%, more than 50%, so to speak. Indian Hotels has also rallied close to 45%, and there is Tata Motors, which has rallied close to 28% in the last 1 year. But just to add a word on Tata Motors, this is one stock I have also personally spoken to him many years back when nobody had a conviction. He said, "Nimesh, this is a stock to watch." And since his buying, I think the stock is up almost 6 times. He was the first to buy at 60, 70, 80 rupees, and now it's trading at close to 600 rupees. So that's been the kind of legacy he's left with. There are some stocks, there are only few of them, who have given negative returns as well. So look at the stocks. Of course, Rallis the family has sold out close to 5%, but Star Health and Jubilant Engraver, these are the two names where the stocks are down 10% in the last 1 year. But speaking about legacy, speaking about the fact that he was one of the biggest bull for the Indian markets, his portfolio is very much intact, and many of his portfolio stocks in the last 1 year itself has rallied between almost 25 to 140%.
And just one stock, Titan, is about 38% of the overall portfolio. The portfolio size is 37,500 crore. Of that, about 15,000 is courtesy just one, Titan, and the holding that he's had in Titan for the last so many decades now. But Nimesh, thank you very much. This is very helpful data, and it's good. It's good for us to jog our memories, right? It gives us a lot about the lessons.
Just look at the legacies left, right? I mean, all his wordings or all the lines that he's spoken in these many years. In fact, even in this last interview, he was so bullish about India, the fact that this is India's decade. Now people are talking about this is India's decade, but he was at least 3-4 years ahead of his times. Even in terms of his investment, he was so much ahead of everybody else, right? I mean, as I pointed as well, Tata Motors is a classic example. There are times when I'd gone and asked him as to why you like this company. There is so much of debt, so much of international pressures as well. And he said, "Nimesh, dekhna ye stock kaise turnaround hoga." Yeah. And these are the words. Right now, there is a massive turnaround which is visible in Tata Motors.
Nimesh, and there's something about it, something about the timing as well. I mean, he left us on the 14th of August. Tomorrow we celebrate the 15th. And from what I can recall, if there has been one hugely bullish voice in the medium to long term on the story of India, the investment called India, it was Rakesh Jhunjhunwala. Thank you so much for jogging our memory, as Rima said, on all the holdings that he has. Gurmeet, so there you have Nimesh kind of made us remember the portfolio all over again, Big Bull's portfolio. If you were to look at some of the holdings that he still has, I'm not going to get into Titan. I mean, that's been widely debated and discussed. But some of the other stocks, some of the other Tata Group stocks, Indian Hotels, I mean, it shot up and how the last 12 months. Which are the ones that you like, and maybe personally that you also have a strong conviction on?
I think one thing he was excellent at is spotting turnaround stories. And one learning from him is that if you stay bullish long enough, you make a photo. 1 or 2 stocks are enough to make a fortune. And for him, I think it was largely Titan and CRISIL. In fact, one of my colleagues, Aditya, has co-authored a book on him. So we continue to live his legacy. I think we got lucky with Tata Motors. I think that's when he started investing, both Tata Motors and Indian Hotels. I think it was a bit of a turnaround thing which he spotted. Tata Motors now, in fact, I remember a few fund managers who met him. He used to be very regular in one of the very famous outlets in Marine Drive, and used to say that this would be India's Tesla. One of the candid moments. And I think look at how it's turned around from 2 digits to, in fact, it will generate free cash flows this year. EVs, they are already have a pipeline of 1 lakh units. JLR, great turnaround again. And even the commercial vehicle segment seems to be picking up. So it's one of the things we benefited from his wisdom. And I think one of his quote I still remember, Surbi, is respect markets. Don't try to time it too much. and change your view if things don't go right. I think that's one of few lines which has stayed with me for a very, very long time.
Or as he said, I remember he once said, Shivaji nahi banna. So, Shivaji nahi banne ka. his way of, unique way. And you said in one of his candid moments, I'll tell you this, Gurmeet, it was always candid with, Rakesh. Never really minced words or held back what he wanted to say, how he wanted to say it. So I think that's why all the more respect that people have for him. We'll take a very quick break here. We'll come back and our Alpha Manager of the Day also will be with us. Sanjay Parekh of Soham Asset Managers joins us in just a bit. Stay with us.
Welcome back. By the way, the dollar index has eased just a little bit. It had crossed 103 in the morning, and now it's down to 102.88. So if you have the dollar index, level, you would see that it's just pulled back a tad bit, 102.8 now. So versus 103 that it was in the morning, and I think that's helping that intraday pullback. But one section of the market which is doing very well are the defense names. So earlier today we had a chat with Garden Reach Shipbuilders. They reported a good set of numbers in the quarter gone by. Their margins have expanded sequentially and on a year-on-year basis. The other income has aided the profitability as well. P.R. Hari, the chairman and managing director of Garden Reach Builders and Engineers, spoke to us earlier today, and he's very confident that the company's growth rates will sustain. The peak revenues for the company will be in FY25, FY26. Listen in.
During this quarter, while we have executed, as you have seen, around 750 crores, we also got a 250 crore order from the Indian Navy for manufacture of 30 mm naval standard guns. So this is what has added and stabilized our order book. Now we are expecting from the Indian Coast Guard, we already submitted our bids. 3 projects, the bid is, the L1 is likely to be declared in a couple of months. So this total value comes to almost 4,000 crores. So our overall target would be to maintain plus 24,000 crores at the end of the current financial year. I had mentioned that the peak revenue generating years will be FY 24, 25 and 26, bang on, and we are right on the target. As you can, it is very evident that in FY 23, our revenue from operations were 2561. In the first quarter, Q1 of 24, we already touched 756 crores. We expect the peak revenue in 24-25.
That's the management of Garden Reach Shipbuilders. Very strong order booking. Order inflows have been strong in the quarter gone by. The company looks confident about execution. Gurmeet, there's only one bit of worry. Analysts are wondering that the current order book may run off, by FY26. What happens thereafter? Are we going to continue to see the kind of order wins, order booking that we've had over the last 12 months? Will that sustain over a longer period of time? So your thoughts on that, and amongst the rest of, in the entire defense basket, which one would you pick?
No, you're absolutely right. I think people don't understand the defense order book as correctly. It's long gestated. There are various payment milestones, and the business is extremely lumpy. And I think a lot of anticipation, a lot of defense stocks have gone up. Some of the PUC names now trade at 30-40 times, earning multiples. So got to be a little careful. Market obviously has few darling sectors. There was pharma and specialty chemicals in 21. There was IT in 2022. And we all know what happens when there is a consensus euphoria around something. We like this one stock we've been very steady and invested since 2017 almost is Solar. It's a nice mix of explosive and defense. Explosives is a quasi manufacturing and power play. Coal India is one of their largest clients, and some of the other miners. And the defense book is now almost at 10%. The stock made 4,500 and then corrected almost 20%. And now again, I think that it's good guidance. The operating margins are continuously improving. They're guiding for 20% kind of margins, and they have a big Pinaka rocket order book also, which is due. So that will take the defense order book, upwards of 3,000 crores. So that's something we have been invested for long. We partially booked out of HAL, but as I said, the space looks, valuation wise, it looks quite expensive. In fact, some of the defense funds, even in mutual fund, have stopped lump sum subscription in this space.
All right. Hi, Gurmeet. Good afternoon. Gurmeet, you briefly mentioned IT as well in there. A couple of these earnings were quite disappointing. Case in point being Tech Mahindra. It has valuation comfort, but the street clearly is looking ahead. How do you all play this IT theme?
So Nigel, there is some bit of negative news in the price. Tech Mahindra, when it came to 3-digit, was 12-13 times. I think the market is probably betting on a leadership change with Mohit coming over. There's a new CEO also, which is coming from Infosys. Mohit has been a BFSI veteran, so I think markets is betting on that. Also, I think that you will see now. I think whatever little feedback we get from some of our clients and CTOs whom we engage is that some bit of large deals may happen. So we saw HCL getting almost a $2 billion deal from Verizon, a few weeks back. Today we saw TCS cracking a deal with Lexmark on cloud and enterprise. So I think one is the disruption part of AI. Second is the business application part of it. So I think there'll be some differentiation, which will happen selectively. And we have seen, for example, some of the niche ERD names like KPIT and others doing very well, despite the whatever headwinds we have had. And in some pockets in large cap, there is some valuation comfort. So if you have an ability to take some pain for a quarter or two, I think from a risk reward basis, this sector looks very, very good. So in large cap, we like HCL, Infi, and Tech Mahindra. In mid cap, we have Persistent, as well as KPIT and Tata Elxsi. So that's our universe in this space. And we are open to look at new opportunities which will come. But for the near term, there could be some pain.
Okay, got that. Gurmeet, good talking to you as always. Thank you very much for joining in. You enjoy your midweek holiday and have a fantastic Independence Day. Thanks for joining in today.
Thanks, Urvi.
Okay. Thank you. Well, the market has managed to put on some more green on the screen. There's about 21 points up on the board on the Nifty right now. Recovery on a couple of names. ITC is helping this move. ICICI Bank is helping the bulls cause today. So is Axis, some of these blue chip banking names. There's Lever. There's a sharp sort of uptick on ITC that we're noticing right now. Divi's is now picking up momentum after its numbers, and there's about a 0.5% gain on Divi's. Again, bulk of it has happened in the last 15-20 minutes. So these are some of the stocks that are keeping the flag flying high for the bulls, at least trying to at this point in time. Sanjay Parekh, founder and chief investment officer at Soham Asset Managers, is with us on the show today. Sanjay, thank you very much for joining in. Welcome to the show. So you tell us, I mean, first of all, let's get your sense on headline things like valuations, because the market rally, which was quite ferocious, up until, I guess, early July. That's kind of now started stalling. We haven't fallen too much, barely 3% from the top, but it is getting a little sluggish. So what do you think of the overall construct, the earnings, quality of earnings, valuations, and just sheer money flow?
Yeah, hi Surbhi. So basically, your earnings clearly are, not cheap. If we take earnings on Nifty at 950 to 960 rupees for 24, and then move to 25, which would be ranging from 1,070 to 1,100. On 24, we are at 20 times plus, which is not cheap for our interest rates. And clearly, we have to look at 25. And on 25 for our interest rates, if we give 20 times on India's earnings for the character of the, overall character of the market is, then there is clearly upside. But, we certainly in equity, you need at least 12-13% return as a cost of equity. So what we believe is there is some time correction which is possible as we transit to 25. And there could be some time price correction as well. But structurally, we are very, very positive. And we believe that, there could be a 3 to 5% downside. And that would be a very, very good level to enter. And in the interim, you could look for stocks which gives you great opportunities to buy. That's our strategy. Yes.
Hi Sanjay, good afternoon. Thanks so much for speaking to us here on CNBC-TV18. It's been a while since we spoke, and good to see from the time you have launched this fund, you have outbeaten actually what the index has done, the Nifty. And the better part is actually that valuation-wise, your portfolio is cheaper than what the Nifty is trading at. So good on you. But the point is, from here on, where do the opportunities lie? You have, you're fairly spread out in terms of opportunities. I'm looking at some of those stocks that you have in your portfolio. Tell us about the way you'll allocate money first between large and mid caps. As of now, you're still pretty much large cap heavy, right?
Right. So, our framework is that, always we would have at least 70% into large cap. And we move into mid and small cap if the threshold of returns is significantly higher. And internally, broadly, the way we talk about it is, can it double in 3 years? If not, at least in 4 years. Otherwise, we'll be into large cap. That over cycles that I've managed earlier, funds at Nippon or even ICICI, that has been the framework I've been following, and it helps. So here as well, we have more like 32 names, of which 18 are Nifty companies, another 3 are large caps, and then the rest of them are mid and small cap stocks. So we are hardcore GARP investors. You rightly said, our price earning of our portfolio is 14.5 times on 25. Our growth is 22%, and our ROE is higher than Nifty. So that is exactly what we follow, growth at reasonable price for the portfolio as a whole. But we clearly love growth, but we want to buy them at reasonable price. So within mid cap, small cap, the strategy is that look for where the size, critical mass is there. They can move up to the next scale. We comfort on promoters. The size of opportunity is large, and the most important is they should double in at least 4 years. And a lot of them, you've seen in our portfolios on the digital space, or all around in microfinance, we do get opportunities like that, and that's what we seek for. But we don't chase momentum. We look for the right entry point. When we are buying mid and small cap, and don't break the discipline of having the threshold of return that we seek. So that's a built-in risk mechanism we have in our framework. And yet, with less risk also, we've got alpha, as it's demonstrated in our 14 months performance.
Sanjay, afternoon. Rima here. Just to get a little stock specific, Jupiter Wagons is one of your bets, and the stock has done phenomenally well. In the last 1 year, it's up more than 300%. Whenever we think of railway wagons, our mind typically gravitates towards Titagarh wagons. Now, Jupiter Wagons has had a name change, so that's also adding to that confusion. But take us through the thesis here. Why did you bet on Jupiter Wagons, and how long will you let it run, your investment, considering the kind of returns it's already given?
Yeah, so we bought this in a QIP, which was at 103 104 rupees, I think 4 months back. The overall size of opportunity was clearly larger. The number of players who have this capacity was lower than the demand, and the demand would far outstrip the supply. Clearly, we could see that. This company has Tata Wagon as a joint venture partner, which is a European major. The domestic promoters own 52%. The Tata Wagon owns 20%. And they are also moving ahead in terms of JVs in the railway segment further in certain components required in the railway segment. So clearly that was an opportunity which was pretty large. The growth in terms of EBITDA, they're expected. We bought at a market cap of 4,000 crores. They will do 425 to 450 crores this year, move up to 550 to 600 crores next year. Very, very strong order book. Very efficient in terms of margins, very disciplined, not having major debt, and the entire expansion plan in the next 3 years would be purely from internal accruals. So that's where we bought in, and of course it's gone quite fast, but we like this stock for longer term.
No, that's well put. Sanjay, hi. You said you don't want to chase momentum, but sometimes momentum chases you, right? Jupiter is a case in point, as you said, 104 to what, 250, 260 in a few months.
Yeah. I mean, I'll be very honest, Prashant. We have a very strict discipline of fair value that we put for 24 and 25. And our fair value for 25 was coming at 250, which has happened in 4 months. So it does happen, markets sometimes move too fast. And that's where the discipline comes off, even if at times you want to book profits, hold partially. And that's what we do very, very objectively in a detached manner. We have our assessment of value. And then, we just, once our value assessment is done, then we act based on that value that we arrived at.
Using this as an example, because buying someone is hard, but selling is sometimes considered an even harder skill in that sense. I mean, so what do? You thought you'd get this price in 2 years, you get it in 4 months. Yeah, we booked. So I'll be very honest, we booked profit in this as well. And it has happened in a lot of small and mid caps. So one is holding secularly for long term. And secondly, when things happen so fast, markets are, the whole psychology, a small cap, the overall flows are pretty large. And the demand, the good stocks demand in terms of supply is limited. You could see that. And hence, at times, if it's so fast, we certainly would book profit. So we don't churn aggressively, but, we do have a discipline of profit booking if anything moves so fast, That's the way we, as I said, we simply have an assessment of value. And while assessing that value, we do look at potential upsides. There could be some deviations, but if there is the stock prices far exceed value, we book profits.
Okay, all right. Sanjay, thanks so much for stopping by. Wishing you all the best, and we look forward to having a chat with you in the coming weeks. For the time being, congratulations on the outperformance that you've seen on your portfolio. Well, when we're having that chat with Sanjay, actually just take a look at what the markets have done. The Nifty has moved up close to around 30 points. So that would be a good recovery. I think it's close to around a 200-point recovery, I think, from the day's low. It's a 200-point recovery, bang on. 200 points recovery on the Nifty. But the Nifty Bank is up close to 450 points from the day's low. So I think if you just get both those two intraday charts up of the Nifty and the Nifty Bank, will tell you a clearer picture about the kind of recovery that we've seen. The Nifty Bank has been the sore pocket. That's recovered from the day's low. And that's what's helped the Nifty as well to move into the green. But as always, it's 3 p.m. So time to turn our attention to our special segment, D-Street Chatter. Nimesh is with us. Nimesh, what are you picking up today? I don't know how many people are at their desks actually domestically, but what are the flows which are like?
Well, the presence is obviously on the lower side. So that clearly shows off in the volumes as well. But look at the intraday recovery in the markets today. I think it's largely led by large cap, and within large cap, it's the Reliance, which has been a big contributor as well. As far as the Nifty is concerned, of course, the Bank Nifty has also recovered slightly from the intraday lows. But in terms of flows, the sense I'm getting is there is still some bit of selling pressure from the larger FIs. I just want to add a line on the flows. If you look at for the last 10-12 days, there is a consistent sell flow from the larger FIs. I was talking to some large, global experts as well, and the general feedback is there is a redemption for an India-dated ETF. It's not that the India-dated funds are seeing redemptions, but there is one particular ETF which is having a redemption for the last many days, and hence you are saying on an average 100 million of selling from that ETF in the last many days. So that actually explains the net FI sell figure in the cash market for the last many days from the larger FI. So that's the overall feedback as far as flows are concerned. Within sectors, metals are under pressure today because of the China news, and that's spooked a bit of the investor sentiment as well. But the PSUs is where the momentum continues. Again, in today's trade, a lot of PSUs which are relatively outperforming, and that's one space which is well bid by the larger institutions as well. So net, the domestic presence is on the lower side. I explained the reason why the FI flows has been negative, but broadly it looks like today's recovery is led by one large name, which is Reliance Industries.
All right, Nimesh, the presence is on the lower side at the desk, which is good. The better news is on our way home, the presence is lower even on the road, so hopefully we get clearer roads to reach home. But tell us some individual stocks. What are you picking up?
So in terms of individual names, the first stock on my list is Z Entertainment. After the NCLT approval, there are first signs of now long-only FIs turning active buyers on Z Entertainment, and that explains in the today's volume as well. So that's the first one. The second stock is Kesoram Industries. Under pressure in today's trade, but the HN activity is quite active, is what I understand in Kesoram Industries, and there is a wide anticipation that maybe the fundraising in this company will come very soon. So that's Kesoram Industries. And the third stock is Godrej Properties. Within the real estate name, this is one stock which has outperformed in the last 1 quarter, so to speak. But even in today's trade, good volumes up in trade, and largely on back of strong FI flows. So this is one stock within the real estate which is well bid by the larger FIs.
Okay, Nimesh, all right, got that. Thank you very much for giving us all the buzz and the chatter as usual. We'll take a break on that note. On the other side, we will come back and get you some final trading calls as well, and more on the markets.
Okay, welcome back. We've got what 8-point change higher on the index. I mean, if you did not look at markets all day long and just woke up and looked at markets now, you'd seem it's a flat day. But that's today's chart, and that clearly shows you what kind of a day it has been. Down significantly early on, and then a very sharp recovery, steady recovery through the course of the day. Mitesh is with us to tell us what to buy or sell today for a reverse trade day after. Mitesh, afternoon. It's not a sudden turn. It's been a turn since the morning after the lows early on. What would you do? What fresh trades?
Yeah. So Prashant, as I said, I think this will not be a downtrending market. It basically is a correction, and now I think we'll go through some kind of consolidation, assuming that this is over. In case we go back to those levels, I think still believe that 19,200 will hold. So we maintain our view that, maybe the good part of declining part of this consolidation is over. Now we can just chop around for some time. On the stock side, Godrej Consumer is something which has come on the list. I think that's reversed very well in the last 1.5 to 2 hours. So that's a BTST. Keep a stop at 1025. Look for targets of around 1055. And on the negative side is Havells, which I would suggest taking an STBT call with a stop at 1285 for targets of 1260.
Okay, all right, Mitesh, thanks a lot for that. By the way, from the broader markets, a couple of stocks are moving quite well. I think Amy Organics, that's one of the only ones from this chemical space that has been doing quite well. That's one of the few stocks that haven't cracked as of now. It's currently at the high point of the day. So Amy Organics is one stock that we should be looking at as we speak. Intraday chart comes up for you. But Divi's Laboratory, that's the big number that came out around 90 minutes or so ago. And on the top line, it was a little lower than what the street was working with. But what the street liked was the margin beat. Ekta joins us. She's been on the con call. She's joining in to give us the key takeaways. Ekta?
Thanks for that. Well, yes, it was definitely a margin improvement which is coming for Divi's this quarter, 28%. So it's really offset that disappointment which has come through in terms of the revenue as well as the profit. Now, the management commentary also seemed to be quite optimistic. They have indicated that they remain optimistic on opportunities emerging. They anticipate multiple growth prospects in the next 2 to 3 years from different segments. Now, in terms of one of their key segments, which is custom synthesis, the segment is doing well. They are seeing opportunities emerge in the contrast media segment as well, and opportunities from big pharma. Now, in terms of the raw materials, that has showed a downward trend and they expect further softening going forward. They also indicated that they've reduced reliance when it comes to China in terms of procurement. They can retain their margins when it comes to custom synthesis, and in fact price pressure has seen some stabilization in the US markets. Remember, that was a pain point for Divi's last quarter, but now they've indicated, like other generic companies, that there has been some stabilization in the US. Overall, they are seeing an improvement in terms of margins and growth going forward, and they have indicated that they do have opportunities coming in from big pharma. They are working on some projects on that front too.
Okay, all right. Thanks a lot for that, Ekta. Well, let's go across to Anand Tandem then, who joins us on the show. Hi, Anand. Wanted your view on Divi's Laboratory. Dream stock, they had a couple of off quarters, but the stock price has recovered and the performance as well has improved. Your take on it?
Well, I think it's in a market where it has certain unique abilities in terms of being able to provide inputs to many of the discovering companies, and as a consequence, the margins will recover over a period of time again. I think for anyone looking at it on a long-term basis, a drop in price is actually a good value. But the only question is you'll have to have the patience to sit through it. In the near term, I think it looks like it has probably hit the worst phase and is looking at moving up from here.
Okay, all right. That is the word on Divi's. The other stock that's been quite a mover is, of course, ITC, which is coming out with results as well. And then there's Lever, which has worked well for the bulls. By the way, the market's now losing some momentum again. We're just about 4 points up. So it's a little choppy. And let's see if we can actually go home with those gains or not. On a stock like ITC, what's the sense from here on, Anand? It's had a great run, and now we know the demerger of the hotels business is finally happening. But what next from here at 450 odd? Would you be a buyer?
It still continues to remain among the cheaper FMCG stocks. And, I would still hope, though there has been no announcement, that at some stage they will also move out the rest of the FMCG portfolio and list it separately, in which case, you will have another phase of value unlocking. But even if that were not to happen for the moment right now, while it, as you mentioned, it has a great run and therefore is likely to pause for a while, I would suspect that the earnings profile of this company will remain more robust than many of the other FMCG companies, given the kind of inflationary environment that one has been operating in. And from that perspective, as a part of your portfolio, I think it still holds a place.
Okay, ITC holds a place as a part of the portfolio. It's amongst the cheaper NBFC names. Wanted to get your views in on PVR Inox, Anand. But before that, let's go over the news. The stock has surged close to about 5% after it witnessed its highest ever daily admissions over the weekend as moviegoers flock to watch the new releases, which include Sunny Deol's Starer, Gaddar 2, Akshay Kumar's OMG 2 and the latest Rajnikant film Jailer, resulting in a gross box office collection of more than 100 crore rupees just over the weekend. Surbhi is joining in with more details. Surbhi.
Thanks so much for that. So as you said, PVR did witness its highest ever daily and weekend admissions. Now in the weekend itself, they had 33.6 lakh customers and earned a box office revenue of over 100 crores. Yesterday itself, they had a 12.8 lakh customers with over close to 40 crores of box office collections. You mentioned 3 movie releases. In the weekend itself, their gross box office collections was over 300 crores. Out of the 2 movies, Gaddar 2 and Jailer, both saw gross box office collections of over 100 crores. In July, they had 3 big releases, Rocky Aur Rani, Oppenheimer and Barbie. Again, out of the 3 big releases, 2 of them saw over 100 crores of collections. So July and August both has seen 300 crores worth of collections. They have 16 movies lined up in Q2 of FY24 itself, and 5 out of those 16 movies have already done well. So it seems like occupancy is coming back in a big way. In Q4 and Q1, their occupancy levels were close to 22%, but Q1 of last year, the occupancy levels were of 31%. So with the movies coming back, it seems like the occupancy can go back to the previous levels that they've seen, that is over 30%.
Thank you very much for that. Anand, PVR has gone through a very long patch where the movies just didn't fire. South Indian movies did well, but your traditional Bollywood movies weren't appealing to the audiences. But now for the last 1 month, we've got so many hits, right? Surbhi was just highlighting them. Do you think the fortunes of PVR Inox are turning? Would you bet on this tactically or structurally?
Well, from the point of view, the fact that it's almost a monopolistic position in the exhibition space, you may want to look at it. But otherwise, I find it a bit of a challenge for it to reach anywhere close to its earlier occupancy on a consistent basis. I think more and more movies are now getting released on OTT platforms directly, and with good reason, because the revenues there are a little more, are directly predictable kind of. And I think there is now a definite and abiding shift that has happened. So it's not as if movie going into halls is going to be the only way you are going to consume content. You look at what's happening in the rest of the world, companies like Disney and so on. I think there is a shift that's happening in media dramatically, which will mean that the traditional modes will have to take a bit of a backseat. Given the fact that it is it's coming off from a relatively low base as far as the pricing is concerned. I think it may still have some place to go, but I would be a little suspect buying it at higher prices.
Okay, well, got that. Thanks for that, Anand. Stay with us. We're just taking a quick commercial break here with absolutely flat indices. Lots of movers, by the way. We'll come back and address some of them. On the downside as well, markets have recovered, but market breadth has not. It's still firmly in favor of what is lower. So more on that. Anand stays on. Stay with us.
Welcome back. Well, the market's more or less flattish as we speak, but let's discuss a couple of more stocks with Anand. Anand, you know, the metal stocks are under pressure. In fact, JSPL's numbers are quite good, but clearly the street is getting a little bit spooked with what's going on in China. However, NMDC is doing well. That's the outperforming metal stock today. Your view on it?
Well, I think you can still probably add that to the portfolio. I think there is still some steam left in that in terms of earnings as well as in terms of valuations. It's not that expensive. For JSPL too, I think there may be some upside if you don't assume that there is a dramatic change in terms of the final prices of their product.
Got it. By the way, I don't know if you have, I think we've discussed defense earlier as well with you, Anand. Good afternoon. It's almost stop-start, and the stop is very brief, but when they run, they continue to run for weeks on end. And today is one more day where we're seeing all these stocks doing very well. We had the management of Garden Reach with us earlier today. We played out a soundbite as well. It's 13.5% gains on something like a Garden Reach. Shipbuilders, by the way, that's the part of the market which is doing very well. Do you own any of them? Have you looked at this in detail? So, you know, the management actually left us with a very large number. They said over the next 3 to 5 years, from the Navy and Coast Guard, the order booking would be, the orders which is expected to come in is about 1 lakh crores. And the sort of players who perhaps will be able to get a pie if it are six in total. 1 private player and 5 government companies. Any thoughts, Anand?
So, yes, Prashant, I have looked at the space, and the challenge earlier was always the question of how much order flow they can get, because at the end of the day, it's a single user market. I mean, you don't typically, many of these platforms are not exportable unless through government approval. You cannot be selling a ship to someone who the government doesn't like. On the other hand, you are pretty much dependent on the government helping you to export. So other than the government, there is only one other mode, which is to export if the government also participates and a foreign power decides to buy from India. On ships, we have seen some of that in some of our neighboring countries. And probably shipping therefore has one of the most stable earning profiles, given the fact that the level of indigenization for most of the 3 services is the highest in the case of the Navy. So, they are the ones who import the least compared to, let's say, the Air Force, which imports the most, and the Army. So net, shipbuilding is a reasonable place to be. But again, the challenge always has been that, unless you have a longer term view, let's say the next 3 years, or let's say even the next 5 years, you will see an earnings growth. And after that, there is a good potential that it will drop off. Because of the fact, as I said, you're not going to keep on buying more submarines and more frigates continuously forever. So you will have to find new market for it. So valuation aside, by and large, I think the fact that most of the defense companies get paid, especially the shipping ones, get paid in advance also helps. Near term, I don't see a major challenge. I think, if you have to be in the defense area, probably shipbuilders is among the safest places to be. HAL2 has a great order book, but their execution always sucks.
Okay. So finally, let's end by talking about some of the newer age companies. We've spoken about some of the industrial companies, some of the defense companies, Anand. This was a quarter that was marked by improved performance for some companies. For instance, Zomato, even Paytm has been showing better profitability traction. But look at how Nykaa has been punished today just because the revenues are fine. But I think their profitability year on year kind of contracted a little bit. Maybe it's just a 1 quarter seasonality. But your thoughts on this space and whether any of these stocks, any of these companies are making the cut for you now as they try and get a little more clear and strict with profits?
So, Ruby, the challenge has been how do you manage valuation versus growth, right? If you try and grow very fast, it automatically results in negative bottom line for most of these companies. And if you don't grow fast, then you can't justify the valuation you're trading at. So net, as these, it's a fine balancing act. I think something like Paytm, for example, has at least found a niche where their payment systems, etc., are doing reasonably well. And since their client acquisition remains very strong, there is, over a period of time, a path to profitability that looks to be established. That said, once it is profitable and you start comparing it with some of the other companies in let's say, the lending space, you will find that they are very expensive. And the growth will have to taper off at that stage. So I would argue that, from a retail investor's perspective, companies which are funded by PEs should best be avoided because they will take the most of the upside away from you at the time of before the IPO, and the IPO comes at obnoxious prices. A case in point, of course, which is 10 years old but which has recently filed for bankruptcy is WeWorks. It was a company which had already gone down the tube, but now it is even something like SoftBank, which put in more than a $10 billion investment, is now looking at cents to the dollar in terms of whatever they can recover, if at all. And the company doesn't look like it may last for very long. So PE-funded companies, which have very strong growth because of the amount of money that they've got in the kitty, are best avoided till they settle down and start showing profits, at which point of time you can take a view on it.
Interesting thoughts there, Anand. Thank you very much for joining in. Enjoy your holiday tomorrow and wish you a happy Independence Day. I just want to once again get back to ITC because they will be reporting their numbers. We had a chat with Anand about ITC, but let's find out what the numbers are likely to be. Mangalam joins in with the key expectations. Mangalam.
Well, for ITC, a lot of the triggers have already played out, so it'll be interesting to see, how the stock's reaction post the numbers would be, irrespective of the numbers. What is it that the street is anticipating this time around? Well, it's an operationally strong quarter that the street is working with, 7 to 8% growth in their cigarette volumes. That would actually be inferred by about 10% growth in the cigarette revenues. The second thing you're watching out for, FMCG business growth continues. So, that's now on an autopilot with good growth coming in, good margins as well, 20 to 15% growth out there. Hotel business, we have seen the run in hotel revenues continue. So 30 to 40% jump is what we're expecting out there. Because of less trading opportunities and the regulations, exporting or banning export of wheat, we're expecting a decline in their agri trading revenues, and paper as well on a high base is likely to see 5 to 10% revenue decline. The most important thing apart from the numbers to track will be any further details coming in on the hotel business demerger. My sense is that it will be the swap ratio which will be announced today as well. Put all these things together, what are you working with? Absolutely flat numbers on the top line, 17,300 odd crores. The EBITDA grows around 13%. That means a margin expansion from 32.5% all the way up to 37%. And the net profit for ITC this time around grows around 15%.
Okay. All right. Mangalam got that. Thanks very much for bringing us up to speed and prepping us on the numbers. That's ITC. It'll be out post-market hours. Well, we're down to the last 1 or 2 minutes of trade, so let's start wrapping things up. Well, the end will be negative once again. The bulls couldn't hold on to that little bit of green 20-30 point rally that we had on the Nifty. Finally going home with a cutoff anywhere between 5 to 6 odd points. The weakness, well, definitely global-facing sectors like metals, so JSW Steel, Hindalco, Tata Steel, all of these stocks are down. Some of the Adani Group, the larger Adani Group Nifty names like Adani Enterprises and Ports also weak. Remember, the news development is that SEBI has asked for 2 more weeks of time to submit its report before the Apex Court. Other than that, we have some more weak names in the form of Tata Motors. These are weak on the auto side. In financials, Bajaj Finance, IndusInd Bank, HDFC Bank, a lot of the banking names weak. In fact, the bank Nifty is what led the last leg of the decline. The reason why we couldn't manage that positive close is because look at the bank Nifty. It's going home with a cutoff. Almost 0.3, 0.4%. IT was trying to do a little bit of the firefighting. Infosys up about 1.5%. Reliance and Lever, along with an ICICI Bank. But I guess, Rima, not quite enough because the net result is flat with mild negative bias.
The net result is flat, but the full day story is that we managed to pull back quite a bit from the session's low. The session low was closer to 19,250 and we're closing perhaps above the 19,400 mark. Divi's Laboratory has also been a big mover on the back of the margin expansion. The mid-cap index is closing in the red, a cut of about 0.25%. The advanced decline ratio is firmly in favor of the stocks which are losing in trade. We've got about 1,000 stocks advancing to about 1,800, 1,900 stocks under pressure. PVR, Inox, NMDC, these are some stocks which gain in trade. Garden Reach Shipbuilders, NMDC, IRFC, HEG. These are all earnings reaction which were rewarded today. And on the losing side, Nykaa takes a big fall of 8.5%. Weakness in JSPL, ABB, Nalco, Krishna Diagnostic. Again, these are all earnings reaction. But by the way, the earnings season is over. Fine.
Well, it is absolutely. But, all in all, a pretty good session all told because it was looking like it's going to be a 100 plus point cut like Friday, we were down 150 and we end with just 15 points red. So 19,400 plus is where we've ended with all that happened in today's session. Well, that's a wrap in this edition of Closing Bell. Enjoy your holiday tomorrow, but don't go anywhere for now. We are coming right back with more on markets on our Independence Day special. Devina Mehra, founder, chairperson and managing director at First Global, and Tridhi Bhattacharya of Edelweiss Asset Management join in on the other side. Stay tuned.